everybody. Welcome to Friday, another Talk Money with Tom show today. We are trying to help you have a more successful retirement, especially in the area of finances. And we do that by answering your questions. So send in your questions anytime during the week, during the show here, right now. Put your questions in. You can send them in two different ways. Ask Tom at talkmoneywithtom.com, email address, or just put them right into the chat here on the channel, and we'll be able to try to answer those live. We really love to hear your questions. We always cover questions that come from our clients during our strategy sessions also, so hopefully that will get us going today as far as that goes. So we believe that there's kind of a lacking in educational content in the areas that we're talking about: retirement planning, asset management, especially in retirement, and tax planning. And so we've created this channel. We've got videos on here. You can peruse those. You can subscribe to the channel. Hit the bell button if you want to get notified, when we put new content on. And then, of course, if you just like to meet with Ethan and I, you can do that. You go to our website. There's a link here on the channel. There's a book appointment button. Looks just like this up in the corner. You hit that. You go through and choose a 30-minute time to meet with us, to phone, video, whatever. And Ethan and I will sit down with you and talk to you about your specific, questions that you might have. So hopefully everybody gets something out of today's show. We really enjoy having you here today and want to thank you for that very much. So do like to start off the week with a summary of what we saw happening in the market. And the first thing we're going to discuss today is really just our signals. We started kind of displaying these last week. As you recall, we kind of have this green, yellow, red concept where we have two different ones: a fast trigger. So when things are moving, quicker with more transactions, something we might use for an IRA or a Roth IRA because we don't have to account for those transactions, versus something slower like a taxable account. And so today our fast trigger actually went red. And so we have red for fast and slow on the stock side, and then the bond side is still green. So we'll be making some changes on Monday. And really for us, when something goes red, it means we move more money away from the stock market towards the T-bill type ETF market, just as a preservation situation. May not be there for long, but just something that we do just to be careful as far as that goes. We'll talk about kind of why these triggers are happening potentially, but overall that's what's going on, in terms of our triggers. And you'll see those come across the bottom of the screen here throughout the show, so you can kind of tell what we're doing. So this is the chart for the S&P 500 going back to the beginning of last year. That was the all-time high, the 4th of January. We had all of these roller coaster rides on the way down. Finally this year we broke through that trend line. We set a new high. And then so far later on in this year, in this first quarter, we've actually come back down to that trend line, bounced off of it again. And so, the question remains at the moment so far, if you look at the kind of checklist of everything you'd want to see a reversal of direction. So we're going from this downturn primary motion to a primary upturn. We've checked off a lot of pieces, but not all of them. And so that's the issue right now. The low that we had was in October. That was a while ago. We've had a nice little kind of run here, and really kind of been going sideways for a while if you look at this pretty closely. And so there's a big battle going on in the market between, the people that believe that things are already as low as they're going to go, and other people that feel like it's going to go a lot lower. And so we're kind of, in this, I guess, zone right now of balance between those two pieces. And if we look at what happened this week, here's a 5-minute chart. We've had what looks like a down week. We'll see how this today finishes. We might end up with a slightly up week, but we're right in that kind of neighborhood. We had a very good beginning prior to the Federal Reserve meeting, right? We had a nice run up. Was really strong, actually. And then the Federal Reserve meeting, they came out and said that they were increasing rates by a quarter point. And you can see that big drop off was at the very end of that day. And the quarter point, I don't think, was a big problem. There was a couple things that happened that day that were issues. Number one, the Federal Reserve Chairman was asked about interest rates for the rest of the year. So the Fed puts out this thing called the Statement of Economic Projections. They put it out 4 times a year. The last one is in December. And what they're saying is, what's their expectation for where rates are going to go? And so they said 5.1% peak rate, which is about 1/4% higher than we are right now. So they're saying we're going to have one more rate increase, and then we're not going to have anything else for the year, right? But the market, and one of the questions that was brought up is the market is looking at that rate coming back down later on this year. And they asked Powell, I said, what do you think of that? And he says, well, we don't see rates coming back down at the end of the year. And so the market responded negatively to that. And then at the very end of the day, there was some more chatter about the banking scenario.
Yeah, what could the market infer with the federal funds rate being kind of sticky? Are they saying that inflation is going to stick around longer than the market expects? Or
Well,
is it kind of
the market, in my opinion, is really looking at a decrease of rates after this 5% peak rate. And so a decrease would be because of a recession. So they're expecting the things to slow down enough where the Federal Reserve in the second half of this year would have to lower rates. And the big change in that thought process is the banking situation. And one of the things that Powell talked about during the meeting was that the banking situation will tighten up credit. So they won't be lending as freely as they might have been because they need the money for their own capital reserves. And that's effectively another way of kind of trying to slow down the economy. So they don't really have to raise rates that much because the banking situation is going to slow things down for them. But the market, if you look at the futures market, which we'll look at here in a moment, is essentially looking at it and saying, well, yeah, but this banking situation could create these other, cascading problems, and all of a sudden the Fed's going to have to be responding by lowering rates. And so, we'll see what happens there. But it's a good question. Here's the Fed funds rate going back to 1955. I just find this kind of fascinating because, first of all, we're not that high right now, obviously. We're below 5%, which historically is less than average. However, you can see how steep it is. The angle of that incline here, right, so the last little run right over Easton's head there is what's been going on here. We came out from 0 up to, almost 5%. The last time we had anything close to this was the beginning of 2008. And I'll tell you what, I guarantee, if the market is having some troubles, it has a lot to do with thinking about 2008 and the things that happened then, and maybe even what happened in 1970s with this massive increase of inflation. And we got the Fed funds rate got up to 19%, which is kind of mind-boggling, really, when you think about it. We've had so many moves here, and we're still only at little less than 5. But so I think that's kind of interesting, just in putting that in a historical perspective. I think the thing that I really liked about the meeting from the Federal Reserve was the fact that they said there was one more rate increase and then they would pause. I think the market's going to like that in the end, assuming something doesn't fall apart on the recession side or something doesn't break. The market's going to like when they start to really pause, and that could be very positive for the market. But one of the things that, and this is kind of to answer your question, Easton, this is the Fed funds futures market, basically guessing where the Fed fund will be at some point in the future. So this is in January of next year. And you could see that it actually was way up there, nearly 6%, 5 3/4-ish, right?
Yep.
And then whoosh, it came straight down. And so the expectation changed because of the banking. When Silicon Valley Bank had its, closure, that started that downturn. And so what that did is kind of woke up the market to say, hey, there's an issue. It's probably not just this one bank. And lo and behold, of course, it was Signature Bank and First Republic and,
Yeah, the cracks are forming.
Yeah, and the Credit Suisse. And so it's not even here just in the U.S. because all banks are investing in bonds. And in very simple terms, what's happening is they're buying these bonds. The bonds, they have a capital requirement that might be up here. And so the bonds are okay. And then when the bond value comes down, right, all of a sudden they got this gap. Right, so the capital requirement, they've still got to fill that gap. So they'll fill that gap by lending less money. That's what Fed's happy about that. But sometimes they can't do that. They need capital, and that's what actually started the Silicon Valley Bank scenario. They were going to do an offering of stock, and that just alerted everybody. And then they had a kind of a bank run.
Yeah, and the crazy part is now with bank runs is it's all electronic, so you can move your money in minutes. It's not like you have to wait in line.
It's a real issue for the banks, I'm telling you, because literally in minutes, a bank could be out of money because of that. Now there is FDIC insurance. There is this big $1 trillion pool that the U.S. has put out there to backstop even past 250,000, which is what they did for Silicon Valley and for Signature Bank, for example. And so, but yeah, it used to be you had to take your passbook down and go stand in line, like the pictures we see from the Great Depression. Now it's just done electronically. So, but this was one of the consternations for the market this week, was just the fact that the market is expecting the Fed to lower rates at some point in the future here at the end of this year, back down to 4%. And the Fed chairman says, hey, we're looking at not lowering that. Now, the problem for the Fed is they said that they weren't going to raise rates in September of 21. They said no rate increases in 2022. Well, you just saw the chart. It was actually quite steep.
Yep.
A lot of rate increases. They said prior to that we don't need to raise rates because inflation is temporary, right? Transitionary. And that didn't turn out to be good. And so they waited too long, and so that's an issue. And so that's where the Federal Reserve has a credibility gap, and the market is saying you're going to drop your rates, and they're saying they aren't. The market has been more accurate as to where rates actually end up. The problem is the Fed can continue to do maybe what they shouldn't do, and that's where things can break down, right? And so that's what's scary. When they say something that contrary to what the market believes should happen, things kind of break down, at least temporarily, until they get more in line with what the market is thinking needs to happen. So anyway, that's what's going on in that segment. So it's kind of two things this week. Is just, what's happening with the Fed, because we had the Fed meeting, and what's happening in the banking system, which has definitely gotten better, but there's still pieces going on. And here's the thing that came up during the meeting also. They asked Chairman Powell, hey, what do you think about the banks, right? And he's like, well, the banks that have had trouble so far were kind of in unique situations. They'd made mistakes. They'd gotten too far out on the bond ladder. They had lent too much money out to risky investments. Their particular clients were, like hedge funds and things that were unusual for the Silicon Valley Bank, et cetera, et cetera. And it brings up the thought process that in 2007, Bernanke was testifying. He was the current, Fed chairman in front of Congress, and they asked him about subprime mortgages, and he said, "Oh, I don't think those are going to be a big problem." And of course, they were. And so sometimes it's hard for anybody to see the connections that happen. But this chart that I'm showing you here is the amount of money that's being borrowed by banks from the Federal Reserve for what they're called their liquidity facilities. And there's all kinds of lines on here, but the blue line is the total. So this is the last 6 months. All of a sudden, 2 weeks ago, 154 billion was borrowed. That's a lot more than normal. And it did drop. And Powell mentioned about the drop, but it was still, still looking at over $100 billion still borrowed, right? So if there's no banking problem, why is there such a big jump in borrowing going on, right? So those are the things that the market is looking at. Okay, this is what the Fed is saying, and this is what we see happening. And I think one of the reasons we're getting our triggers to kind of these red triggers that are coming up is because there's things happening behind the scenes that we don't really know about, right? We didn't know about Silicon Valley Bank. The market had already started down before that, right? Other people know about Silicon Valley Bank. And so my big emphasis is always to kind of focus on, the price, look at what's happening with the market. And we're having some decent times, but whenever we get a chance to really run, it's kind of lopped off, right? And it's just not enough strength. And we're really kind of going sideways. But we need to see motion forward here to get out of this, and we're not seeing that. So there's the possibility of motion backwards or going down too. So to put this chart into perspective, though, if we take this back, this is just 6 months. So the last 6 months, big hike. But if I go back all the way to before 2008 on this chart, you can see that right over, between Easton and I here is that little bump we were just looking at. Doesn't look nearly as ominous as it did 2020, big jump, and then of course 2008. Oh my gosh, yeah, a lot of money being borrowed. So
yeah, it's pretty similar to 2012. That little
it is.
bump.
It's a lot more like 2012, and it probably is a lot more like 2012 because The one thing that we have that's different than 2008 is the fact that we have this pent-up demand. We have consumers spending money. I mean, they're out there spending money, and they're driving this thing. Now, that creates some inflation, it creates some other problems, but you can't have high inflation and a big, giant recession. They don't go together. So at the moment, big concern about giant recession, big concern about spending too much money, they're kind of equaling out. And that's why the market's kind of going sideways also. So there is things that are happening that are kind of interesting. However, there's more and more things pulling on those consumers to make it harder for them to spend, because of the interest rate increases. So they're borrowing on their credit cards. That's going to cost more, as they raise rates and those types of things. So I think it's a period of time to, be a little cautious, not too worried about things, but we're definitely going to be adding some T-bills to the accounts on Monday, assuming, Monday isn't a big giant up day. We follow a little system day by day to see when we should do these things, but that we got the signal, so now we're basically on watch to see what happens. So, all right, well, that's our summary for this week. Great that you could join us. Look forward to kind of doing a summary again next week, too.
What are your feelings on the current debt ceiling debate?
The debt ceiling came up yesterday. The market was doing okay, and then all of a sudden we had a drop into the negative. The House GOP is working on a list of things that they would like to see happen, especially in the area of cuts to spending in order for them to back the debt ceiling. So my long-term outlook on this, well, long-term, last 3 to 6 months, has been we need, in order, probably got the Democrats to vote for it. They control the Senate. They control the White House. That's fine. So it comes down to the House. And they do not control the House. We need 6 Republicans to step across the aisle and vote for a debt ceiling increase. I think that happens. However, I don't think it happens until things are getting pretty crazy.
Yeah, and also to bypass the speaker, I think you need 30 procedural days or something. There has to be a certain amount of days, so you can bypass the speaker, but it takes time.
Yeah, and time is getting shorter because they're talking about the debt ceiling. It's already been reached. We're already using what they're calling extraordinary measures. And those run out in kind of July through September timeframe. You'll never hear an exact date because there's a lot of little things they can do, and it kind of depends on what revenue comes in from tax collections, and it's very, very complicated to get that down exactly. But what happened in 2011 when they really pushed it out to the edge was that the stock market dropped 17%, and worse, we got a downgrading on our U.S. government bonds. So I do think that that's hanging out there. That wasn't a great thing. That was the Tea Party that really kind of ran that. They got kind of hit pretty hard in the election after that. So I think there'll be some saber rattling here. Definitely, we'll probably get farther than we want to. It'll probably have some impact on the market. It's one of the reasons why we are really, happy to have this green, yellow, red light scenario, so we can kind of respond to that. But I suspect it'll get a little bit nasty, but maybe not quite as bad as 2011, because again, this is at least partly a political move, and people are going to want to, make this work. So
I don't think the majority of people want to see the U.S. default.
Right. No.
So there's political backing for not defaulting.
Yeah, and let's face it, if you look closely at all of the debt ceiling arguments, the drop in the market has been getting less pretty much consistently every time. First time was 17% in 2011, but the last time at the end of 2021 was 5%. And if you look at those, it's been getting better and better. And again, because the market looks at it, I guess it's sort of like crying wolf in a way, right? And people are looking at that as buying opportunity because generally speaking, as soon as they resolve it, the market comes straight back. So if it's down 10%, buy, with the expectation that they are going to resolve it. And that's why you see support coming into the market now. People are looking at, and we even saw support yesterday during the downturn that happened after this discussion started. some buying came in and kind of drove it back, at least to a slightly positive territory for the day. So I think the debt ceiling is a big picture. We're starting to see, continued inflation improvements, not as maybe as well as we'd like, but still improvements. Federal Reserve's talking about pausing on their rate increases. That's a really big deal.
Mm-hmm.
We're starting to knock things off that have really been bothering the market. And of course, now we're going to be saddled with this debt ceiling conversation for a little while, and probably still create some issues for the market. However, it is kind of interesting, barring some other massive collapses or things that might happen, we're starting to kind of check off things. When that debt ceiling piece does get taken care of, you could see a period where the market is doing well. You probably won't have the Federal Reserve running around saying so many harsh things about, the inflationary environment, how much they're going to raise rates. And so that helps. And, there's just got to get through this debt ceiling piece. So, and we'll be cautious, and we'll be, careful with that as far as that goes, just in case somebody does get carried away here.
Yeah, and you remember, you don't want to react too early because then you get
Right.
stuck.
Yep, exactly. All right, what's our next question?
What's going on with Deutsche Bank?
Deutsche Bank, okay, so it's the latest bank now to be in the news that's having some issues. I didn't, it's just an ongoing issue that, this is one of the things that I was thinking about this morning before I even heard about this, was that, the problems that we're having in the banking system here in the U.S. is not going to be unique. It won't be just the U.S. banks. And they buy, you put money in, it's in a money market or a CD or something fairly short term, and then they lend it out longer term. And they can lend it out by purchasing a treasury bond or put it out to a mortgage, right? And so that's all fine. They make the difference between that. They pay you, 1 or 2 and make 4 or 5, and that's what makes the world go round. But when the bonds had such a terrible year last year, it really did affect things. And so it's not just here. I do think there's more of it here. The U.S. bond market got hit pretty hard because we had run up so much.
Yeah.
And maybe like in Europe and some of these other places, and the bonds that they might be buying more of there, although U.S. bonds are bought pretty much everywhere, to be honest. But there might be less impact. But of course, we saw Credit Suisse, right? And now we're seeing Deutsche Bank. And so, it's a piece of the puzzle that is driving the market to the downside this week. Is this continued area, because although we have this nice facility now set up for an emergency basis to kind of backstop the banks and backstop depositors here in the U.S., we can't control all of these banks around the world. And so what do they do? Does one of these countries either have to or want to let one of these banks go under, and does that create a contagion throughout, right? So those are the things we're watching for. And again, watch the price of the market. If the price of the market is deteriorating, there may be something happening out there that we will find out about in the future. So, that's what I watch for in these time periods. You can, the news is way behind what's actually happening.
Yeah, and with single issue stocks, you have to remember that also there's an emotional side to how their prices react. And so you can see a stock slide very massively. It may be more because people just have fear, or it's just people get loss aversion is a much stronger feeling.
Yeah, exactly. Yeah, that's a good question. It's definitely topical.
How does someone maximize their Social Security as a couple?
Yeah, there's actually, I used to do seminars before the pandemic on maximizing Social Security, and it's amazing to me actually how complex Social Security is. It's just like everything else that we do. It's kind of funny, the IRS tax code is tens of thousands of pages long, and so Social Security is one of those areas where there are some things that you can do to try to make sure that you're getting as much as you possibly can, and it can make a really big difference in your retirement. And there's a lot of interest in this area. So let me share.
And it's pretty hard to get information too, because when you go to the Social Security office too, sometimes they just don't give you all the information that you need.
Yeah, exactly. No, well, you got to remember, and actually, the Social Security Department is probably not where you want to go to ask questions about what you should do to maximize your Social Security. Not because they don't want to help you maximize, it's because they don't know all of your other details.
That's true.
And so that's one of the reasons why my seminar was so popular, because a resource to ask about Social Security is somebody like me. And so I can look at all of the different pieces. We can run it through our Social Security Maximizer software. And so here's an example, Joe and Mary sample. Sorry, James. James is 61 and Mary's 59. His PIA. So what's PIA? You remember?
Oh, PIA.
It's the projected. Boy, now I'm forgetting it too. Projected insurance amount. Look it up. We'll get back to you. I just had a brain fade there, but 2,000. It's what you should get at your full retirement age.
Primary insurance amount.
Primary insurance amount. There we go. Got it. $2,000 for James, $2,500 for Mary. So life expectancy. Now this is the big one. When you're trying to do these calculators, how long are you going to live?
Yeah, that's the guess.
So you can get Social Security between 62 and 70, right? So if I wait, I'm going to get something extra if I wait, but I'm also not getting the money I could have got at 62 or 63 or 64 or whatever.
Can you live till the break-even point?
Can you live to the break-even point and beyond? So you got some profits, right? So this is a big one. How long are you going to live? The longer you live, the better it was to wait to take Social Security because you can really get into the profits big time. And so this life expectancy is sort of an average one, really. It's not a long one. It's just sort of a median number.
Yeah.
That looks fairly low to me when I look at my clientele, but it's not a bad place to start. And so we can crunch this through the calculator, taking their PIA and their expected, and it says, okay, here, number one, if they claim early, and they live to those ages, they're going to get a little over $1.2 million. So they take it at 62, both of them. All right, not bad. If they both claim it at their full retirement age, right? So full retirement age used to be 65 for like my father.
Yep.
For me, it's 67. And so for some people, it's in that kind of 60 plus a certain number of months, 66, sorry, plus a certain number of months, but right around 67 for most people they're looking at now. So they would get more by waiting. So even though they got paid more, right, during the 62 to 67 range here, they actually earned more because the Social Security amount increased, right? Now, the other part here, James claims early and she claims later, right?
Yep.
So in this case, he's claiming it, between 62 and 67, so sometime early, and she's claiming it at 70.
Yep.
Right? And so that's worth about the same as both claiming it at full retirement. But there's a big advantage in that number 3 that's kind of hidden. And that is that if Mary passes away, James, she has the bigger one. She had the 2,500. So and they've allowed her to grow even more, all the way out to age 70 in that case. If Mary or James passes away, the bigger one stays. Mm-hmm. If you took it early, the bigger one's not very big.
Yep. And
so if you want to take care of yourself as a couple, have one of them stay out until age 70 if possible, unless you can't. And most 58% of people take it at age 62.
Yep.
And there's a variety of reasons. People don't feel like they'll live long enough. They want to get the money now. Social Security might be going out of business, all of these things. But I'd say the number one reason is people need the money. I mean, they don't have any money. So, because the average retiree here in America doesn't have any money. But if you have the money and you're trying to maximize this, then that number 3 is quite interesting, at least as an option, because one of them will be big as it can possibly be. And if something happens to the other one, it doesn't take such a big jump down in your overall income for that person, for the survivor. And that can be really damaging. So look at number 4 here. It's just where both people waited till age 70.
Yeah, this is just the maximum money possible.
So that's even better. Both wait till age 70. Now, again, you have to be able to afford it and all these things. And if you have some type of life expectancy issue, we can figure out the break-even point. It's usually around 76 to 79, someplace in there is what I kind of see usually. A lot for break-even by waiting until 70 instead of taking it at 62 or 67 or whatever it is. But this is a lot more interesting than it seems. Social Security seems kind of like a dry subject, but it's actually an area where you can kind of make some money and make some good decisions.
And the problem with Social Security is it's kind of you make that decision, you can't really do a redo on it.
Yeah. They do give you like a 1 year period where you can put the money back in. I've never heard of anybody doing it, but it is,
Yeah.
technically available. But yeah, you get to a point where there's no choice. And so that's why, again, our seminars were full every time, because people are looking for answers to this, and it's difficult to find the answers. And you won't find these answers at the Social Security Department. They're pretty much, told not to give you the answers just because they could make a mistake.
Yeah, if they make a recommendation,
Yeah.
they would be liable,
Yeah.
and so they kind of just give you the information, and then you have to interpret it yourself.
Yeah, but it's a very good question. I think it's a really interesting area altogether. All right, so what's our next question?
How do you calculate your required minimum distribution (RMD)?
So RMDs, okay. So this is a big subject within our retired clients, appointments, is the RMDs and what's it going to be, how does it work, and it is a forced income distribution out of your IRA, 401k, 403b, 457 type retirement plans. So if you put money into a retirement plan and you never paid taxes on that because you got the write-off when you put it in and it grew tax deferred, the government wants you to start taking money out.
They want their taxes.
They want their taxes. And so they've changed things. They've made it a little bit better. It used to be at 70 and a half you had to start taking it out. Then they changed it to 72. And now they've changed it to 73, right?
Mm-hmm.
So let's look at kind of a visual here of kind of an example. So here we have, required minimum distribution, RMD, right?
Yep.
That's what it stands for. And let's say you take your retirement account balance at the end of the year, right? So 12/31 or 12/30, whatever the last trading day was. You divide that by what's called your life expectancy factor. We're going to use a 77-year-old here as an example, just to say. So let's just say in this particular case, at the end of 2022, the balance was 400,000, right? So first thing you do is you go to the table. That's a little hard to see. Let me change to this one here so we can see that better. There we go. And so here's a 77-year-old. The distribution period is 22.9 years. And so you're going to divide that 22.9 into that 400,000, and that's how much you have to take out sometime in that year, in this case in 2023. Yep. Doesn't have to be right away, but by the end of the year, whatever that dollar amount is, and we'll look at that in a minute, it has to come out. But I want to point out something on this table. If you notice, that factor continues to come down. So for like an 81-year-old there's a line under that, 19.4. When you divide an 86-year-old, it's 15.2, right? When you divide by a smaller number, you're getting more that has to come out.
Yeah, your RMD increases each year.
And if you look down there about age 93, you're dividing by 10. So 10% is coming out at that point, if you live that long, right? But it is interesting here that by age 120, it's still 2. What that means is if you happen to make it that far, there's still money in your IRA if you've just been doing it, because until you divide by 1, right? When you divide by 1, that's it. It's all out. So it's an increasing amount of distribution, assuming an even return on your investment. So because your 400,000 can turn into 300,000, and even if you're dividing by a smaller number, you could get a smaller RMD. Right?
Yeah, and so they're expecting, kind of a rough way to think about it is they're expecting to live another 22 years. And usually the uniform lifetime table is you and your spouse, because they kind of combine you into one person.
Yeah, that's right, because one of them's going to inherit the asset and continue on, right? And so, here again, here's the overall. You take that retirement account balance, divide it by this, life expectancy factor. So again, it was 400,000. Factor was 22.9. The required minimum distribution for this particular person is $17,467.25. You can't take out less. It's a 50% penalty for taking out less. You can take out more. I have no problem with that. They'll tax you on it. And so, this is a taxable distribution. A lot of our clients withhold when they take it out of here, so they don't have to come up with a bunch of money at tax time. Some withhold 25% for Fed and 5% for state or whatever, And so then the net amount hits their banking account, and they can do whatever they want with it, to live off of it. We have some clients that transfer that right into their other account,
their trust
account, and that way it just kind of keeps the investments rolling. And so there's different options you can do. But again, one of the biggest changes that's happening for 2022 was that if you are 72 this year, right, you do not have to take out a required minimum distribution. If you were 72 last year, you did.
Yeah, so they changed this.
They changed it just now with the Secure 2.0 Act. So if you happen to be 72 or younger, you do not have to take a required minimum distribution in 2023. And so you can wait until 2024 as far as that goes.
Yeah,
so,
and they've also increased the age later. So if you're in
That's right.
2033, it'll be 75 for your RMD.
That's right. So 75-year-old in 2023, which is 10 years from now, so it's a ways away.
Yeah.
But they are, because it is a bit of a problem. We're seeing bigger and bigger 401ks and retirement plans, and this 17,000. Imagine that's $4 million. That's $170,000 worth of income that has to come out, and we're seeing a lot of those, especially here in the Valley. Very big retirement plans. And now I got $170,000 in my tax return, whether I need it or not. I might be paying more for Medicare because of that. There's a bunch of different problems that come from this. Roth IRA conversions is one of the possible solutions to that. It's something we work on and talk about quite often. So there's a whole bunch of things here. But RMDs are a really, really fascinating area. Again, at least for people like us. So I guess that's why we're here. All right. What else we have for questions?
So keep hearing this term called super core CPI. And can you explain what super core is?
Super core CPI, yeah. So they just keep making up these new things like disinflation and all this stuff we're learning. So, CPI is the Consumer Price Index. There's lots of different measures for inflation. It's the one most people know about. It's the one that was just reported, about 10 days ago. And so they have what they call top line CPI. That just is everything in the basket, right? It's the one most people are familiar with, right around 6% right now, right? And then they call it core CPI. And so core CPI is the next step down. They take out food and energy. And the reason they do that is because the Federal Reserve wants to focus on core CPI. It's where they feel they can have an impact. Right? Food and energy are these wild cards that's very difficult for the Federal Reserve to bring those prices back down. They focus on core. Well, one of the parts of core that's been getting kind of a lot of bad, press is the housing portion of it, because housing lags dramatically, right? So most of it, they basically what they do is it's rents.
Yep.
And so even if you own a home, they assume some value for rent that you would be paying to live in that home. Well, and based on actual rents that are being paid. Well, rents are signed up for, on usually a yearly basis, and they change, very slowly.
Yeah, people are saying there's like a 6-month lag period with rent, with house prices.
Exactly. So here you are, you're fighting inflation, you're trying to figure out what to do for the Federal Reserve, and you're going to raise rates, and those rates increases aren't going to be felt for a long time for the economy. And so maybe we need to take out this lagging piece of and we look at supercore, which takes out not only food and energy, but it takes out rents, housing in this particular case. And now we're focusing more on really probably the goods and services inflation that is much more appropriate right now. And rents are important, but they just lag so much they kind of create some problems. And so they do have another measure of inflation that the Federal Reserve actually pays more attention to, which is called PCE, Personal Consumption Expenditure, and they look at core PCE. It's got a lot of services in it, and it's the one thing that Powell brought up on the Wednesday meeting was core PCE, where it was. It's at 4-point-something%. Needing to get that down to 2%. And so always remember that. When you hear CPI is at 6, needing to get to 2, that's not true. They are looking at core PCE, getting that down to 2. Still a ways to go, but it was a lot higher. So, we're heading in the right direction as far as that goes.
What does PCE stand for?
Personal Consumption Expenditure.
Okay.
It's just a different basket. It's a little bit strange because it comes out so late. It'll come out essentially the last day of the month for the month prior. But the Fed looks at that much more so than CPI. So, they do look at CPI, but they key off of PCE a lot more so.
Yeah, the next release will be on the 31st.
Yeah, that's right at the end of the month for February. Yeah, so nobody pays attention, but we should. It's important. All right, I think we have time for one more question.
How does the Fed lower inflation without breaking the economy, as we're starting to see the cracks form?
That's a good question. I don't think they know. I mean, unfortunately, that's the problem. If you look back to 1994, what they call this soft landing, that was the last time we had a soft landing. And the reason we know about it, because it doesn't happen very often.
Mm-hmm.
So what happens is they basically raise rates to fight something, and it generally breaks the economy. So we had 19 rate increases prior to the 2000 downturn, and we ended up with a 45% stock market drop, and we wiped out the internet bubble. Not a bad thing, but it was, kind of a crazy thing. And then in 2008, they were fighting real estate prices going crazy because they were lending money to anybody for any reason whatsoever.
Yep.
Negatively amortized loans and all these crazy things. And we ended up with 21 rate increases and a 57% stock market drop. So in both cases, you can make the argument that they were successful in fighting what they fought, but they overdid the rate increases. Mm-hmm. And so this is what scares the market the most when Jay Powell says, I don't see rate decreases coming for the year, and the market's expecting rate decreases to happen because they're expecting softness in the economy that the Fed's going to have to respond to keep from breaking something.
Yep.
This is what scares the market because in the past, they have gone too far. And in their defense, it's incredibly difficult to look at today's data, make a change to these interest rates that are going to affect data 3 to 18 months from now.
Yeah, you're making an educated guess, and you don't know with 100% certainty what the outcome is going to be.
No, and they're economists and lawyers, and it's kind of interesting. So it really it's a great question because I don't think the Fed does know. Now, the one thing that is going in all of our favors here, and I'll bring this up again and again because it's so critical. This is not 2000. This is not 2008. This is not 1970. And the big difference is pent-up demand coming from the pandemic and the amount of money that's still sloshing around in the economy that was pushed out. I mean, $4.4 trillion ended up in the banking system in 2020 because of all the money that was pushed out, right? A lot of that's been spent, but there's still a lot left. And then we got credit cards, and we've got home equity credit lines, and we've got refinances that gave us, I mean, my mortgage, my savings was pretty substantial. I dropped down from a 4% to 2.75%. That money's in my pocket every single month that I could spend, right? All of that happened during the pandemic. And so this is something that's offsetting all of these fears for this big something breaking scenario. And this is probably the one argument that you could make for a soft landing in this particular scenario is the fact that the Fed might not be able to keep up with the spending, to be honest. I mean, they can raise rates at a pretty fast rate, and people are spending at an even faster rate. I mean, we've seen some pretty big numbers coming out. We're about to get earnings again for the first quarter coming out. We had Nike already report that it was good. Their consumer stock, definitely. And they did very well, and they had a big run-up in their stock based on their announcement also. So that's kind of the very early one is Nike. So that's hopeful too. So we'll see how that plays out. So don't lose hope here. This is not 08, no 2002. Even though the Fed has made a lot of mistakes in the past, we do have this kind of offsetting piece that might keep everybody out of trouble.
And then the Fed's also slowing down.
Yep.
They're only predicting one more rate increase, and so that slowdown could be also important because it lets the market settle. And
Chairman Powell left the door open to not have another rate increase at the next meeting. He mentioned it because I think that's quite possible. The bet right now is 50-50 on rate increase or not, and that'll change as we get closer, as we get more data. But I wouldn't be wildly surprised to see no more increases. And I hope that they pay strict attention. They're very focused on trying to fight this inflation, but they have to be careful. It's definitely they're walking a tightrope here. All right, well, that's our show. Well, some great questions today. I really appreciate everybody that sent in your questions. feel free to send them in again. Keep us going here. We're doing this show just for you. We really enjoy this. We're trying to educate the public on how to have a more successful retirement. And so you can send those to Ask Tom at talkmoneywithtom.com. You can, start your educational process by, subscribing to our channel, looking at what we have on there already. Hit the subscribe button and the little bell to get notified. And then, of course, you can, book an appointment with Ethan and I if you want to ask some specific personal questions. We can do that too. You go to the website, hit the book appointment button, and we'd be happy to talk to you. So thank you so much for coming today, and I'm really glad that we got a chance to help you, and look forward to seeing you next Friday. Thank you.